Take a look at your screen. If you're like most intermediate traders, it's buried under a dozen lagging indicators, all screaming conflicting signals. Intermediate traders today are drowning in data. The resulting analysis paralysis causes more account failures than any lack of information ever could. And out in the 2026 market, hesitation is expensive. These high-frequency trading algorithms are specifically programmed to hunt down the liquidity resting right where retail traders hide. One of the easiest places they find it is behind a fixed pip stop loss. Many traders arbitrarily place a flat 20 pip stop on every single setup, completely ignoring the current volatility of the asset. This chart illustrates exactly how that plays out. The average daily range of a pair like USD-JPY can be 150 pips. High-frequency algorithms create sudden spikes that easily whip through a 20-pip buffer, pierce your boundary, and then immediately reverse into your predicted trend. To survive, you have to stop searching for secret algorithmic signals. You need to wipe the chart clean and focus entirely on institutional bias. Profitable trading right now requires a radical subtraction of data. This minimalist setup relies on a single pillar, the 200-period exponential moving average. Institutions use it to define long-term trends. If price is above the EMA, look for longs. Wait for a pullback into a value area, the sweet spot between the EMA and structural support. But identifying the right trend means nothing if your stop gets clipped by random noise. This is where we replace fixed pips with the average true range, or ATR. This diagram shows a single candlestick with an ATR bracket measuring its recent volatility. By placing your stop loss at 1.5 to 2 times the current ATR, you guarantee your risk boundary expands or contracts with the market's actual pulse, multiplying outward to keep you safe. Because the physical pip distance of your stop changes with volatility, your lot size must fluctuate to balance it out. A wider stop requires a smaller lot size, ensuring your total dollar risk never exceeds 1% of your account. By combining the 200 EMA with an ATR-adjusted stop, you stop reacting to random price spikes and start mathematically aligning with true institutional momentum. Trend and volatility give you the where and how, but price action alone won't tell you if you're walking into a retail trap. To avoid this trap, you have to determine exactly who is on the other side of your order. We can measure the exact behavior of the retail herd by filtering setups through the FXNX AI Speculative Sentiment Index. This gauge displays retail sentiment skewed heavily to one side. If AI data shows 85% of retail accounts are long on an asset, the smart money is almost certainly looking to sell. We use this reading as a strict go-no-go filter. Once the trend, volatility parameters, and sentiment align in your favor, the final step is pulling the trigger. This image displays our highly specific trigger mechanism, a glowing pin bar candlestick or engulfing pattern sharply rejecting our predefined value area. A pin bar tells the literal story of a failed auction. It shows the precise moment large institutional players stepped in and aggressively pushed the price back in the direction of the macro trend. A professional trade leaves zero room for guesswork. It requires a rigid checklist, an institutional trend, mathematical volatility boundaries, contrarian sentiment, and a defined candlestick trigger. Executing that checklist on a single trade isn't enough. A professional career is built on running a statistical edge consistently over thousands of repetitions. This risk-reward visualization compares a small $100 risk block to a $200 reward block. In 2026, a 1-to-2 risk-to-reward ratio is your mathematical floor. It guarantees your account will grow even if you lose half of your trades. To protect that math, you implement a strict 2-loss limit per session. 2 stop-outs in a single day means your read is wrong or the market is too erratic. You shut down the platform to preserve your capital and eliminate revenge trading. Moving from an intermediate trader to a consistent professional requires radical discipline and proving your edge before risking a single real dollar. We call this the 100 setup rule. Use automated replay tools to manually log 100 historical examples of this strategy. By the time you finish, your execution will be driven by historical probability rather than gut feeling. To guide your backtesting process, download the 2026 Anti-Complexity Checklist PDF linked below. Then, log in to the FXNX demo platform. Utilize the 0.0 pip spreads to practice executing your entries with exact precision. The market does not reward complex charts. It rewards the courage to simplify your process and the discipline to execute it perfectly.